Now that we have the various elements that can go into the profit and loss statement, like we have created a separate working schedule for operating revenues and expenses. We have created a separate schedule for depreciation. We have created a separate schedule for interest and principal repayments. Of course, we still did not create anything for tax, which we will be doing it. But with all this input, I would like to start off with the base initial skeleton of the profit and loss statement. So once we prepare the base initial skeleton of the profit and loss statement and populate it with all the necessary elements, we can very well think of what else it needs to be obtained, like the tax element, and probably we will talk about other income or even other expenses. I'll try to bring in into our P&L statement, and from where they can actually arise. All these things we are yet to find out as a part of our P&L statement. But at least once we make a base skeleton P&L statement, we'll have all this information to work out with. So, taking that as the base input, let's start preparing the initial profit and loss statement. And just I think all of you would be comfortable in terms of saying any expense, for that particular year or for that particular period, or any income for that particular period exclusively dedicated towards that particular period will go into the profit and loss statement. Anything increasing the outstanding or decreasing the outstanding, those things will go as a part of our balance sheet. So we'll try to consider the key elements out of this particular project that will go as a part of the profit and loss statement, and try to create one, and then we will move forward creating the cash flow statement as well as the final balance sheet for the same. But yeah, before we get into it, we will start off with the profit and loss statement preparation part. So I'll create a separate sheet saying P and L statement, profit and loss statement. So the first two lines, anywhere we are preparing a kind of year-wise kind of a schedule, I would like to maintain the consistency which is highlighted in every sheet. If that is blank, I will leave it as blank. Otherwise, I'll populate it with that particular value. The first two cells, I'll maintain that level of consistency across, and the same thing I'll drag it until the period AZ. This consistency let me maintain across, because this is the one which will handle even if the number of years have gone up or gone down. Now, as a part of this P&L statement, probably it may or may not be in the exact same format as IFRS or Indian GAAP or whatever it is, but yeah, the elements need to more or less be sufficient. Elements need to be sufficient. So that's where, so whenever I use the revenue scenario, right, basically it contains the set of revenues and expenses. We have two categories: operating revenues or revenues from operations, and I also call as other income. Where does this other income come from? I have two sources for other income. As a part of this particular solution. One, see, it may so happen that every year, after revenues, expenses, and various other scenarios, every year I am left with a cash surplus. Wherever I am left with a cash surplus, I can deposit that surplus, and that deposit can fetch me an interest. So this interest which I am getting out of the deposited surplus is also a kind of a revenue or an income for me. So that is one thing that goes as a part of other income. Two, very soon we would be talking about what we call as a DSRA account, Debt Service Reserve Account. In most of the loan cases, the bank, what it may do is, it may ask the borrower to open a DSRA account. And what is the purpose of that account? As the word itself is saying, Debt Servicing Reserve Account. You are creating a kind of a reserve account or a kind of an FD, kind of a fixed deposit, whose minimum balance need to be probably some portion of the outstanding debt service. So the most common scenario is the 6 months worth of the interest and the principal repayments that are outstanding. The minimum balance that should be there in this debt service reserve account is probably whatever are the interest and the principal repayments that you are supposed to do in the next 6 months, maintain that much amount as a part of the DSRA account. So because it's again another kind of a fixed deposit, or because it's another kind of a reserve account, and that is just as a caution deposit kind of an account. In case you are not able to pay your interest and principal on time, the bank can very well take it from that DSRA account. That's the main purpose of the DSRA account. So because it's a caution deposit kind of a thing, it's your own account that you are maintaining, there is an interest that is given even on that account, just like any other fixed deposit. So even that would go as a source of your income. So basically what we are talking of is the other income will come from two sources, but of course these two sources will be known to us only when I prepare a cash flow statement. Only after I prepare a cash flow statement, I can talk about what is the cash surplus or what is the cash deficit. Deficit also we have a mechanism to handle, but at least the cash surplus that can get generated, or what is the DSRA requirement for each of these periods, I can handle these things, and whatever is the interest that I am getting on the top of these two accounts will go as a part of my P&L statement as a part of the other income. So that is where I am handling the other income here. And finally you are saying the total revenues. The total revenues are going to be something like that. Then we are talking about expenses. Operating expenses, which are something to do with the project, the bus shelter, whatever we have prepared as a part of revenues and expenses. The revenues go into revenues from operations, the expenses go into operating expenses. Apart from that, what else do we have as expenses? We have interest on loan, right? Interest on loan is an expense. And we also have depreciation, which we have already prepared, even that's an expense. Then lease payments, lease rentals, even that's an expense for us, right? For which we have already prepared a schedule. And insurance. Insurance, even that is an expense for us, because we are taking the insurance until the project is existing. So the insurance is something, and probably any other expenses that are there, we have to. And interest. Okay, interest on overdraft. I'll talk about this. See, in case we fall short of cash, probably in any of the years, my cash inflows are much lesser than the cash outflows, but I still have to make those payments. So I would be borrowing cash, or I would be borrowing on a very short term basis, and that short term borrowings intermediate to meet my cash flow requirements are typically classified as overdrafts. And on those overdrafts also I am bound to pay the interest, so that also goes as an expense for me. So that is what will go as a part of the expense. So probably from these 4-5 areas, I will compute my total expenses. So whatever I am going to be left with is nothing but profit before tax. Taking into consideration all those things, I am going to be left with profit before tax, and from there I will be taking out the tax element. We have to prepare a schedule for tax also. I'll be taking out the tax element, and finally I would be left with profit after tax. So this is the kind of a skeleton we are talking about, and we have to fill in this particular skeleton with all the necessary values. Okay, revenue from operations, easy to pull out, right? Simple logic. If this is equal to O only, this value will be applicable. If this is equal to O, I will pull it out from the total revenue sheet. Otherwise, I will leave it as blank. So this part is easy to update. So revenue from operations, I am directly linking it to my revenue from operation sheet. Easy to handle kind of scenario. Alright, let me check out whether things are updated properly or not. Yes, before I move further, I think the better way to handle this entire thing is do a formatting of this entire area, a number based formatting, so that it looks much better. Then other income is something which we currently don't have information on, because only when I prepare a cash flow statement I will get to know whether I am having a surplus cash or a deficit cash. So it has to come out as a kind of a recurring loop from the cash flow statement itself. So right now I don't have the information for the other income. So I would, but still I would create this formula for total revenues saying if this is equal to operations, then do the summation of revenue from operations and other income. Otherwise, leave it as blank. So with that input, probably I'll populate up to here, and this is what is giving me that these are my total revenues for the period. Same way expenses, operating expenses are straight to be obtained. If this is equal to O, I am populating it with the operating expenses, total expenses from operations. I am populating it with this particular number, otherwise I am leaving it as a blank. So consistency in the formula is very much important, because if you see we are writing so many formulas on the spreadsheet. So it's very difficult to correct the formulas once they go wrong. It's always better to work out with the intention of doing it right the first time itself, rather than trying to correct them at a later stage, because it takes a huge pain in terms of correcting the formulas. Rather than that, if we try to work it out correctly in the first step itself, it creates a lot of betterment for us. Alright. Now, when I am talking about the interest on loan, I know that the interest on loan is coming from this particular sheet, which should come from this area, right? Which should come from this area. So, the way I can handle it is, I know that this is the cell which has to fill in those particular values, right? So all I will do is I'll use a formula called index, because this is in column row format, whereas my interest here is in the column format. So it's better that I start addressing. It's better that I start addressing from this particular location. Create an index on the top of that. And pull out the value. What I would simply write is, I'll create, let's say, this as the array. Whatever is the number of periods, I'll take that particular scenario as the array. So let me try it out. So 1, if this is equal to operations, then what I'll do is I'll take the index of the array will be taken as from here till somewhere down. So that is my array. Within that array, pull out the year number plus 1 period. Pull out the year number plus 1 means pull out the second row for the first year, pull out the third row for the second year, and so on. So because if we see, I'll go back there, what my index formula is giving me, otherwise I will replace it with a blank. I'll explain this formula again. See, what my index formula is doing is, if you see here, in this particular array, the second row in this particular selection, the second row corresponds to the interest for the first year. Third row corresponds to interest for the second year. Fourth row corresponds to interest for the third year. So n plus 1th row corresponds to the interest for the nth year. That is what I have written here. So pull out the n plus 1th row, which is the year number plus 1, and corresponding to that particular row number, pull out the value. So the interest on the loan for me is working out now. I can drag it across till the last, and the same logic, interest on the loan is getting applied only up till the 15th year. So these are the interests on the loans for each of the years, right from the third year onwards. The interest is applicable. So this is the interest on the loans, and it is getting decreased year over year. Very good. Then we are getting into the next aspect, modeling or computing the depreciation. Same logic. If this is equal to O, then only I will populate the depreciation. For depreciation, we have created a schedule, and please keep in mind that the depreciation, what we take in the financial statements, is the straight line depreciation only. So I'll leave that, and the remaining thing is left as a blank. So when I'm dragging it across, the same logic, the depreciation is actually becoming, these are the total depreciations over each of the years. This is one more expense that is coming out in each of the years. Similarly, we are talking about lease rentals. The same logic, if this is equal to O, I am bringing in whatever my leasing sheet was. If that was equal to O, I would point out to this particular value as the lease rental. I'm only bothered about the rental because rental is something that's an expense for that period, but the deposit is something which would go in as a part of my balance sheet. So right now I should not bother about the deposit part. The rentals part, I'm treating it as a part of my P&L statement. So the rentals wise, I have modeled this saying if it is operations, as long as the period is operations, the rentals are applicable. And again, the same logic will take some kind of expenses each of the years towards the rentals also. And similarly, for the insurance, right? Insurance, we are talking about 1% of the construction costs. That is what has been highlighted as a part of the insurance cost. So every year I can very well maintain the same amount of insurance, or the other way I should look out is look at my depreciation schedule. From the total project, take out the total depreciation because the value of the asset has got depreciated during that usage period. So from the total value of the project, take out the total depreciation that has been done till date, the total value that has been depreciated till date, and only on the balance that is remaining you can compute the insurance cost for each of the years. Right? You can compute the insurance cost for each of the years based on that particular logic. So what I can very well do is the same logic I'll apply it for the insurance also. If this equal to O, then only I am talking about the insurance as an expense, because the first 2 years whatever is the insurance that is applicable, we have already figured it out as a part of our construction costs. So as far as the project is concerned, as far as the insurance is concerned, what I'll do is, as long as this is the operations phase, I will take the total project cost. What is my total project cost here? I can get it from my construction. This is my total project cost, right? This is my total project cost. I'll be subtracting or probably let me say summation of the total project costs and minus summation of whatever has been depreciated till date. So for whatever has been depreciated till date, I could consider something like this, wherein I will put A under $1, A10 to A10. So whatever has been depreciated until the previous, I will sum and subtract it, and to that particular amount I will multiply the insurance cost. What is the cost of insurance for me? Whatever is the total construction cost, 1% of that is what I'm treating as my insurance expense. Otherwise, if that is not an operations period, I'll simply leave it as blank. So let me see, there is something wrong. The summation of the construction as well as this. Okay, here probably I may not require this particular bracket. So let me try dragging it. So the first year of operations, yes, this is the insurance that is applicable. As I am moving along, because some depreciation has already occurred, the insurance amount is also actually coming down during the period. So we have to give some kind of a thought on all these numbers, and towards the end the depreciation is going to be the asset is completely depreciated, so almost the value of the asset has gone down, which has resulted even in my insurance costs also typically going down in that particular year. Now, the interest on overdraft. Right now I don't have the information regarding the overdraft, because that would be computed only when my cash flows are prepared. So right now I cannot figure out the overdraft or the interest on the overdraft into my model. So what I would be considering is leaving that also. After I make the cash flow, I will update the P&L statement with those kind of elements also, but right now I can leave that as blank. But while computing the total expenses, I will definitely consider the same. If this is equal to O, I'll do the summation of all these expenses, otherwise I'll leave it as a blank. Okay, so these come out as my expenses during the operations period. So total expenses during the operations period work out to be these kind of numbers. Total revenues much higher than the total expenses, except in the initial few years I have my total revenues lesser than the total expenses, but as the period is growing, my total revenues are growing at a much faster, which means initial few years I'm not able to break even comfortably on the project, but as the operations are growing, there is a possibility to break even more and more, or probably there is a possibility to generate more and more positive profits and more positive cash flows during the life of the project. So doing from this, I can even compute the element of the profit before tax, wherein I am doing the same logic of if this is equal to my operations, if this is equal to operations, I'll do the summation of the total revenues and the negative of total expenses. Otherwise, I'll leave it as blank. So the profit before tax is working out to be these numbers. And right now I don't have the information regarding the tax also. The next one will try to work out on the tax element. But these are the profit before tax kind of elements. And here also, to make the representation much better, wherever it is negative, I'll take the format of wherever it is negative, then probably I can ask for negative number to be represented with red, so that I can identify it quite comfortably. So in the first 2 years there is a possibility of a loss, But as the period is progressing, we are generating huge positive profits over the periods. Okay, something good for the project, but we have to see overall. But tax right now we don't have. So what I can think of is I can do the same, at least for profit after tax. So we have a responsibility to fill 3 or 4 elements. So I can talk about the profit before tax and the negative of tax to create my profit after tax. So summation of the profit before tax and the negative of tax to create the profit after tax. If it is not operations period, I will leave it as blank. So up to here, my base skeleton P&L is ready, right? We can very well play around with my numbers, and probably we can observe how these numbers are getting impacted on your P&L statement. How various calculations are impacting your profit and loss statement. So we can very well summarize it through this statement. And of course we are yet to fill the other income, maybe good positive in few of the years. We are yet to fill the interest on overdraft, which also will get from the cash flow statement. And we are yet to fill the tax. Tax is something which we will prepare now, because as I discussed earlier, when we talk about the tax, the major thing that we will be discussing is not on this depreciation, but we would be focusing more on the depreciation that is done on a written down value method. So we will look at the difference between these two depreciations and how we take into consideration these elements for the computation of tax. So once those separate schedules for tax are prepared, we will link that with this particular P&L statement. And finally, this helps us in assessing the profitability of the project. Alright. So the major thing as an important stressed item in this particular exercise is how well I can use the various formulas of Excel, because in this sheet we have used the index formula for pulling out the interest on loan. All we are looking at is the Excel formulas are like basic building blocks which can be molded to our requirement to create various dynamic models satisfying the purpose of various financial requirements. So here also this kind of model, though we are taking some time to prepare it, it has a lot of robustness built into it. Just you want to check it out, instead of 2-year construction period, make it as a 3-year construction and 34 years of operations. Just come back to your P&L. The P&L is prepared only from the 4th year onwards. And if we see the profit before tax, this is the number, and the profit after tax, the numbers are changing, and even for the up to the 36th year, 37th year, the flow is being prepared, and we will get to know the various changes that are going to come up in each of the years accordingly, right? So that's how we can mold each of our calculations, and we have to make sure that every step that we are taking is going to really impact our profitability in what manner. That kind of exercise has to be done as a part of the good financial modeling attempt, right? Now I am sure that you know how to prepare a P&L statement given the details regarding the revenues and expenses, the interest payments, the leasing related expenses, the depreciation related expenses, the insurance related expenses. How do we prepare a base P&L statement which can be used for submitting it to the banks for the for even obtaining the loans, or for getting some kind of suitable terms and agreements, or for your internal evaluation of the profitability of this long-term project. If you have any kind of queries regarding this aspect, feel free to get back to me on the number that I have given below, or you can drop in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session, and I hope you will be comfortable in preparing the P&L statement. Thank you very much.